All right, let's talk a little more broadly about the markets right now. Mohamed Al-Arian is Allianz and Gramercy advisor, also the president of Queen's College, Cambridge. And Mohamed, we've been kind of watching the 10-year very closely. It's back above 4%. That's the first time that's happened since November. Is the market starting to believe the Fed when it comes to this idea that they are going to raise rates higher and leave them there for longer?
I think the market is going beyond the Fed. I mean, look at the 2-year. I think that's the most important price to look at right now. And I don't know whether it's hyperspeed or to infinity and beyond, to go back to your conversation with Dom, but the market has moved the 2 years by almost 100 basis points since the day after the last FOMC meeting. And it's basically signaling that the Fed has fallen behind yet again. So keep an eye on the 2-year. We need that to stabilize in order to have a foundation for risk assets.
Hey, Mohamed, to this point, we've been asking, why isn't the 10-year going up more? Why aren't people paying attention to this? You think the 10-year is going to have to, the yield's going to have to go higher from here yet?
Yeah, the minute you go to the 10-year, as you know, you're bringing in a whole set of other issues, including growth. And the concern that's in the market, and we've seen how inverted the curve remains, is that we may end up having the Fed tip us into a recession that's totally unnecessary. You know, every time the Fed falls behind, and this is the third time it has fallen behind in 2 years, every time it falls behind, the probability of the Fed tipping the economy into recession goes up. So that's what you're seeing in terms of the yield curve, the 10-year versus the 2-year.
Okay. You've brought up this idea in your op-ed that you wrote today. You've brought up this idea of the Fed having some credibility issues once again, just because they went to 25 basis points last time around. You think it's harder for them to go to 50 basis points, even though we've heard several Fed officials say 50 basis points is on the table for them this next time around?
It is hard. You know, I was against them going to 25. I was on your show before the FOMC meeting. I wrote it down saying, don't downshift yet, it's too early, but they downshifted. So now what do? If you go back to 50, which is what the data warrants, if they are truly data dependent, then they should go back to 50. You do two things. You undermine your forward policy guidance, and you undermine the narrative of disinflation. Remember, that word was said 11 times by Chair Powell during the press conference. But if you stick to 25 and go higher for longer, which is the alternative, you risk slowing into hiking into a slowing economy, and you undermine your credibility even more. So, you know, it's the tragedy of the second best. The further you are away from the right policy response, which they fell behind on, the more whatever you do has collateral damage and unintended consequences. That's the reality of the world of second best that the Fed finds itself in.
Let me lay out a theory from Steve Schwarzman. He thinks that a lot of the inflation that's been created is there because consumers have this unusual savings rate that, you know, they stopped spending during COVID. They couldn't go places. There's a lot of pent-up demand. Their entire cost structure went to zero. They were still making as much money, a lot of them who were working from home. All of that went into savings. Once COVID left and everybody came back out, you saw this huge surge in spending. And they're still spending all of that money. I think his expectation is once the savings run out, you are going to see a return to normal in terms of what consumers are spending and what they're spending it on. If that's the case, I mean, that would argue for the Fed kind of pausing and taking a look around. If we're going to get to the end of that unusual savings rate, let's say sometime this summer, maybe it kind of cures itself. And if the Fed raises rates too far or too fast, there's that lag effect, and then kind of runs into a wall itself, that the economy shuts down because all of this was unusual activity surrounding COVID and the COVID lockdowns.
Becky, you just summarized really well the complexity of policymaking. But look at European inflation. We had the numbers today. Core inflation is at a record level in Europe. And what we're seeing is the dynamic that we're seeing here is that inflation migrates from goods prices and starts getting embedded into the system and then starts getting embedded into wages. So the issue with everything you've just set forward here is, what do you do about wage inflation? What do you do with workers rightly looking to protect their purchasing power. Inflation has evolved. It's no longer about goods inflation. It's no longer just about service price inflation. We're now seeing it in wages as well. And this is why the European numbers are so important. They are relevant to us. What is happening in Europe isn't going to stay in Europe. We're seeing exactly the same dynamic in Europe that we're going to continue seeing here.